Good evening and welcome to another episode of Night Markets. Financial markets close at 5 p.m. and night markets open at 6 to widen the conversation. Each week I'll be giving you my perspective on what's driving markets as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research at SFO. So during the week, global markets reflected a familiar tug of war between corporate earnings, inflation concerns, and central bank decisions. The US led with impressive gains, powered by some strong earnings. Europe also followed with moderate growth after another ECB rate cut. And Asia struggled a little bit with mixed economic signals, balancing inflation concerns and weak consumer activity. So before we move on to markets and macro, let's just have a check-in on the current situation in the Middle East. Hezbollah escalated tensions with a drone strike that killed 4 Israeli soldiers, prompting Israeli airstrikes on southern Lebanon. Amid accusations of Hezbollah using US peacekeepers as cover, Israeli forces damaged UN infrastructure and demanded their withdrawal, complicating the diplomacy that the region is currently having. While ceasefire discussions have advanced, both sides continue military action, casting doubt on any lasting peace. Despite the initial fears of supply disruptions early in the week, oil prices surged but dropped on Friday, reflecting market optimism for a possible diplomatic resolution. Defense stocks, however, remain strong during the week as geopolitical risks still linger. So looking at markets and macro and starting in the US, US markets surged during the week with the S&P 500 marking its 6th consecutive weekly gain and also closing at a record high. The Dow also added 0.95%, while the Nasdaq rebounded later in the week until strong earnings from Taiwan Semiconductors and Netflix, boosting sentiments in the AI and tech sector. Retail sales data exceeded expectations, while lower jobless claims also lifted optimism. However, a 0.3% decline in industrial production pointed to some economic softening. Treasury yields also edged higher, with a 10-year yield reaching 4.09%. And then moving across the Atlantic to the Eurozone and the UK, the European Central Bank cut rates for the second consecutive time, lowering the deposit rate to 3.25%, while we also saw inflation slowing to 1.7%, fueling hopes of further monetary easing in the near future. In the UK, inflation also eased to 1.7%, the lowest number we've seen since April 2021, as transport costs and wage pressures declined. UK GDP also expanded 0.2% in August, driven by manufacturing and construction, though the Bank of England remains cautious about further easing. And then just looking at the market performances, the Stock 600 index ended higher by 0.58%, with most of the stock bourses in the region ending in the green, and the UK FTSE 100 also gained 1.27%. And then moving further east to Asia, Japan's stock markets declined, with the Nikkei 225 ending down 1.58% as inflation slowed to 2.4%, raising speculation that the Bank of Japan will actually maintain its accommodative monetary policy stance. The yen also weakened to 149 against the US dollar, nearing intervention levels we saw earlier in the year. In China, Q3 GDP growth of 4.6% beat forecast, but still missed the government's 5% target. Industrial production rose by 5.4%, and retail sales gained 3.2%, signaling some recovery despite lingering deflation risks. Despite some shaky news, the stock markets in China rose, with the Shanghai Composite gaining 1.36%, and the CSI 300 also up almost 1%. Mostly driven from the possible further stimulus we'll see from the Chinese central bank. And then moving back home, South African retail sales rose by 3.2% year over year, reflecting improved consumer sentiment following the recent retirement reforms as well as lower borrowing costs. The SARB also hinted at a potential rate cut by year end as inflation pressures continue to ease. And then just looking at the markets, the All-Share Index gained 1.22%, led by resources and financials, with the former actually ending higher by almost 7%. The rand weakened to 17 rand 60 against the dollar by the week's end, mostly reflecting dollar strength we saw offshore. And then just ending off with the week ahead. So in the coming week, we'll see earnings reports from Tesla, IBM, and other major US companies. These will provide further insights into profitability and the current market trends we've seen. On the macroeconomic front, we'll see US home sales, jobless claims, as well as durable goods orders. In the Eurozone, we'll see the release of some key manufacturing data across the region, while locally CPI figures due out on Wednesday will give us a guide on the possible future path of interest rate cuts in the local economy. And then, as always, we'd like to end off with an interesting investment idea we've discussed during the week. This isn't a new one. We've actually spoken about it once or twice, but we do believe of the benefit of having gold in our client portfolios. And despite gold having a massive run of late, we still think that there could be some upside. So despite the general acceptance that gold is an inflation hedge and very much driven by inflation, the principal driver of gold is actually the expected real return from other long-term financial assets, particularly equities. With the equity market currently trading at all-time highs in the US, the expectation could be there that we could start to see equities trending down, hence making an additional case for gold. Also, if we look at ETF holdings, they've actually been trending lower for the past 4 years, while gold has been making new all-time highs. So in the modern world of the internet age, news mentions and social media chatter on gold specifically have also been trending lower for the past 4 years. This doesn't necessarily paint a picture of a very euphoric bull market, despite gold having risen very substantially. So this could make the case for gold to still have some legs to run. Thank you for joining me for another episode of Night Markets. Financial markets close at 5 p.m. and night markets open at 6 to widen the conversation.